Resume.
Here we
There
go.
you go.
All right, we're in. Well, I'm gonna do my best to cover for Victor. We got Cafecito with Lamas, with the Lamas. Um, I know a lot of you, well, some of you guys know a lot about these programs. Some of you may not. I know there's some new friendly faces here, but I'm gonna do my best to kind of go over, touch up everything. For those of you who know me, right, I like to have these meetings more of a conversation type training, right? If you do have a question, feel free to butt in and interrupt me, and ask away, because by you guys asking questions, other people are learning at the same time, and some of this stuff to me is very natural, and I already know this stuff, but some of you guys may not. And again, this training is not to know every single thing about every single loan, but have a good general background of what type of questions are answered by questions that are asked by clients, whether they're selling to refinance to buy another deal in cash, or a purchase that they need to sell a property and then they need to take funds from there and move stuff around. There's always gonna be crazy scenarios that a parent is selling a house and they don't have the credit and income, but then they're gonna gift it to the daughter so they can buy it with them on the loan. So there's all kinds of scenarios on here. So we're gonna get started. So this is an overview of what we're gonna go over. I'm not gonna take too much time in each program, because really we can dive in, especially FHA and conventional. Is a lot of it can get deep, but we're gonna go over FHA, conventional, VAs, bank statement program. There's also no income, no job investment program as well. I'm gonna just briefly go over 4 national loans too. And these are always topics of concern that I can't hesitate to go over. Victor probably even went over it too in the past, but we'll go over some contract pitfalls, stuff to avoid if there's some appraisal permitting issues during the process of the financing. Most of this stuff relates to in contract, when you get in the contract. Some of it's going to be before contract, if we need to increase the credit score, for example. Condo associations, I put an angry face because it's an additional step in the process, and a lot of associations don't have, I don't know if most of you guys heard of it, but like we have to ask for the budgets, to make sure they have enough reserves, make sure they're good standing. And I put these angry face because some associations are not really they're not the best. I don't know if you guys can agree or not. So employment changes, we gotta keep an eye on that. Credit rescoring, we can increase credit scores if they're not high enough. And then sourcing funds, any large deposits, we're gonna go over that, what can kill the deal, especially when they're making, taking money out and putting it back in cash. It's not good for the financing process. So again, as I'm going over this, feel free to butt in, ask questions, even if it's a current deal or prospect or a client that's going on right now. All right. Or if you're even hearing it from a different lender, to confirm information, because as lenders, they tend to be good salesmen, and they'll tell you what you want to hear, and they'll say everything this to you. Yeah, we can do it. And when it comes down to it, then, because of this happened, and they blame it on, point fingers at other people. So, I mean, if you guys want to hit real shit, just ask away. So FHA minimum down payment is 3.5% down. Technically the FICO score that we look for is at least 580. Although when you do have a 580 credit score, they do ask for compensating factors. It's not always a slam dunk deal. It's not just, hey, you have income, you have the 580 credit, 3.5% down. No, sometimes they're gonna want 5% down, 10% down. It's subjective. But ideally, I tell everybody, try to get at least 600, 620, so you don't get hit, with bad terms on the loan. And that I speak that just like I wouldn't give, a family member a 580 credit score loan when their payment's gonna be super high and I know they can't afford it. 100% of the funds can come from gift. Okay, so they don't need to have all the funds. So if I'm buying a house and I give it over, and I need $20,000, and my father's gonna give me 20 grand as a gift, that is allowable. Okay, we do just need a gift letter from them, and also we need to show that my father has enough money in his bank account. So we do need to show that bank account as well as a gift letter, but that's it. Do I have any questions so far? Mortgage insurance for the life of the loan, right? So we have MI, PMI, as they call it, for literally for the life of the loan when you are putting 3.5% down, even 5% down. Interesting enough, not many people know this, but once you put 10% down on an FHA, it literally automatically goes away in 10 years. So if you have an FHA loan, you put 10% down upfront, the MI disappears in 10 years. It doesn't go away when you reach 80% equity, nothing like that. It goes away literally on the 10th year.
Victor, I don't understand that. With the mortgage insurance, what do you mean? Like the insurance they get on the home?
Right. So don't get confused with mortgage insurance and homeowners insurance.
Okay.
Right. Mortgage insurance is literally an insurance that the bank obligates you to have to the borrower when in this case, FHA, you have to have mortgage insurance because it's an insurance that's going to protect the lender, the bank, in the event that you default.
Gotcha.
You stop paying, they get paid out a premium. They get paid out lump sum.
Okay.
You know, it's literally insurance, like exactly what it sounds like. It's insurance on behalf of the mortgage in case the borrower defaults. The bank gets a premium, because then they're left with a bad loan and it doesn't look good. Okay. So homeowners insurance is more of like, hey, if a hurricane comes and takes away my roof, then I have insurance and, I could pay a premium, my deductible, whatever it is, and then they can cover and repair the cost. All right. And that's that. And when I'm talking about monthly mortgage insurance, I want to clarify that we're talking about the monthly mortgage insurance, because aside from that, there's also an upfront mortgage insurance premium that gets added into the loan, right? Again, I'm not going to go to every single detail about each program, but I want to say these things to you guys because the next time you hear about it, you can you're already exposed to it. Oh yeah, I heard about that in that training before, or oh, you hear about it, because this ain't no training. This is not a study session. Then there's gonna be a test at the end of the class. It's not. So I just want to really expose to you guys of what's going on here. So, and again, if you put 10% down, the MI goes away after 10 years. If you put less than 10% down, that mortgage insurance stays for all 30 years, unless you sell the property or you refinance the house. So if you have a borrower that has 20% down, I wouldn't recommend them going FHA unless they have other reasons to. So that way they don't have to have this MI. Rare condo approval. I say that because there's not a lot of associations, condos that are going to get FHA approved. I mean, the FHA requires similar things like the conventional, but then they also request added documents, balance sheets, financial statements, rules and regulations, a lot of other additional documents. All right. But it can be done. Don't say it cannot be done. I've done one. I think we did it with Yessie. You there?
Oh, wow. I muted myself by accident. Sorry.
Yeah, no, it's all good. We've done an FHA.
Yeah,
it was like, tell me, what did you think about that? Honestly, straight up.
Honestly, just never trust when the listing agent tells you, hey, there's no reserves. Always do the diligence yourself and make sure that that you can do FHA or that you can, because I had to submit an offer saying that I was doing a conventional loan. So when Angelo looked at the budget, he's like, I've done FHA here before. I mean, it was a little bit like extra work, but it was worth it. I was trying to help my client, especially when there was barely anything in the market at that time.
Yeah. And you may wonder, why would a person even go FHA in a condo? And there's many reasons. Either they could have a foreclosure that happened 5 years ago, and according to the conventional guidelines, they cannot go conventional. They have to wait 7 years if they have a foreclosure. So FHA is probably the best way to do it, only way. Or they can't qualify conventional because the numbers are too tight, the DTI, or maybe they don't have a high enough credit score to go conventional.
Yeah,
FHA
I don't think they had the credit score for it.
I think it was a mix of the credit score and also the DTI, because FHA allows you to purchase a higher amount of property as opposed to a conventional loan. You know, a lot of other factors, but in this scenario, that they could only buy FHA. And I think I remember we started conventional, we were trying it, we are trying to squeeze it in, and then we had to change it to FHA.
Yeah, that's exactly what we did.
Yeah, once we changed it to FHA, we did let the listing agent know, hey, we sent the contract conventional, right?
Yeah, but then we had to do an addendum switching the loan from conventional to FHA.
Yeah, and we did that just for protection, you know, for the borrowers, because sometimes you say, you know, the buyer's gonna apply conventional, and then they switch to FHA, and then who knows, they could have that attorney on the other side be like, oh, well, you never really tried conventional, and yada yada yada, and you know, they could bite you in the butt. But we let them know, and we even provided. I said, listen, we're not trying to see if it works or not. Look, I have a loan commitment here, for FHA. We want to switch to FHA, you know, and guess he sent the addendum, and they both signed it, and you know.
I mean, yeah, she did give me a hassle, like, hey, why are we switching to FHA, this and that, but it's like, you're already, a couple of weeks in the deal, like, Angelo had to talk to her because I remember she was like upset about it, but the deal ended up going through.
Yeah, and I think everybody should leverage their loan officers that they're working with, whether you're working with me or whoever. You know, you got a family member, whatever it is, you should really leverage the loan officers and tell them to help you, get this deal accepted. Tell the loan officer, hey, go call the agent, the listing agent, back us up. Let them know how strong the pre-approval is. So again, yeah. So FHA will allow a higher pre-approval amount compared to conventional. They're stricter on the student loans. So they have very strict guidelines for student loans. They hurt you on the DTI aspect of the qualification. So if you hear, but it's still manageable. So if you ever hear a borrower or a client or prospect say, oh, I have so much student loans, I'll never get qualified, say, hey, no, you may have a lot of them, but we could probably get you a conventional loan, which they're less stricter guidelines. Assuming we could just provide a document saying that, hey, I have $150,000 student loans, but according to my income-driven repayment plan, I'm only paying $100 a month, and that's all we look at. We hit them for $100 a month for conventional, right? FHA's appraisals stick for 4 months. I'm gonna kind of put an asterisk on this one, because I think we had a deal, Mike, Lillian. I want to get your take on this real quick. We had a deal. We had a deal on an FHA for Mr. Herrera, right? Appraisal was done in December or January. I don't remember. There was okay, so we put an offer on the property, and when we were ordering the FHA appraisal for the property, there was another lender that had an open FHA case number that they did an appraisal about 5 months ago, but they never canceled it. Luckily, 4 months passed from the last appraisal that was done, FHA appraisal that was done, and we were able to cancel it. If we had gotten in a contract within the 4 months that the previous appraisal was done, we had to use that appraisal. We had to use the value. And in this case, the value was lower. And we were able to order a new appraisal, and the value was substantially higher. Thank God. You know. Okay. I asked you to talk, but I think I did said everything for you, I guess. All right. Let's see. We're gonna just sprinkle in conventional loan right now. So funny enough, the actual lower down payment of the two is actually conventional, is conventional with 3% down, right? 3% down. This is really for first-time home buyers that you'll be allowed to put 3% down. This consists of only a requirement of this is that you have to be a first-time home buyer, which in mortgages, the definition of a first-time home buyer is if you have not owned a home in the past 3 years. So if you sold a house, if you had a house and you sold it 4 years ago, you're eligible to put 3% down, assuming you qualify and get approved. Okay. Credit scores is minimum 620. Okay. Then goes to 620. Will you get approved for 620? Again, compensating factors. You probably need more money, more money down payment. The DU, we have to generate an approval on the DU, automatic underwriting system. But 620 is the bare minimum. But most of the time, you probably need more money down, or maybe get a co-signer that has a higher credit score to generate the approval. But it's case by case. But let everybody know, you wanna get leads. So let people know, hey, yeah, you 620, yeah, for sure. But get them pre-approved, try it out to see if it works. Like FHA, the 100% of the funds for down payment can come from a gift. They could come from a gift, okay? Funny thing is, on a conventional loan, you don't need a bank statement to show like FHA. So if my father is going to give me $100,000 from him, his bank account, and he's my father, all I need is a gift letter, right, to show that my father is going to give me $100,000. And those funds do not have to be sent to the borrower's account. They can be during the process. They don't need to send it the bank. They don't need to send the money to my account. My father can send those gift funds directly to the title company. Yes, he is in the waiting room. All right. Monthly mortgage insurance funds. A chat here. What time is it? 11:20. Doesn't it go away after 80% of the mortgage is paid? If we're talking about FHA, then no. I mentioned earlier that doesn't matter if you are putting 80, if you have a property and then it reaches 80% of the mortgage, of the purchase price, let's say, it stays on there on an FHA. Only conventional, look right here, on a conventional, monthly mortgage insurance can be removed, but you cannot remove it on an FHA loan at all. It only goes away after 10 years if you put 10% down. Okay, again, it's a very specific scenario here. All right. There is a 3% down. One second here. There's a 3% down option that you can actually remove the monthly mortgage insurance. So this is pretty cool because I've actually used this a lot in the past, and it's a good method to make people qualify if they have extra cash, and they're literally at the cusp of getting approved for the deal or not. So what we do is that instead of paying monthly mortgage insurance, which it could be $100 to $300, $400 a month, instead of paying that per month, you you buy it out for a lump sum, and that could be from $5,000, $4,000 to even $10,000, depending on the loan amount. So instead of paying, $150 a month of the monthly mortgage insurance, you'll pay $6,000 upfront at closing to remove the monthly mortgage insurance. That's a tactic that I like to use personally to restructure the deal to make it work, because we need to make sure that they can make their mortgage payments, right? Conventional loans also have a 10% down option for condos. This is assuming if the reserves are bad. And when I say reserves are bad, we'll get into it a little bit later. That refers to, that we're looking at their current year of 2021 budget. We did to see if they're allocating enough reserves in their budget to meet Fannie Mae guidelines, meaning to meet conventional loan guidelines. Because if their reserves are bad, if their finances are bad, then there's more risk. And then when there's more risk, the bank requires 25% down, right? But there is a 10% down option, assuming that the borrower has a great credit score of a 680, 700, and everything else checks out. The income checks out. So again, case by case, but there are 10% down option for condos. All right. Can you guys hear that? No, I'm assuming no.
Yeah, 10% on those.
Yeah, no, but there was my computer was ringing. Nobody heard that?
No.
All right, good. That was my Google Voice ringing. Actually, I'm gonna show you guys what like my process structure is, just so you guys know. If you guys do send me a lead, I'm gonna show you guys like my train of thought of my processing of how to do things here afterwards. Conventional, they're more friendlier to student loans. Like I mentioned earlier, conventional loans, assuming that you have an income-driven repayment plan, even though you owe $1 million in student loans, if your monthly payment is $100 a month, that's what we use. All right. Any questions here so far? Nope. Good. All right, VAs. VAs tend to have a 0% down payment for all veterans. I really like this. I really like the program. It's probably the best program there is because it has low interest rates compared to conventional. And I mean, if you're a veteran, zero money down. You do have to pay your own closing costs and prepays, though. Okay, but when we say zero money down, 0% down, that is just for the purchase price down payment, but you still have to prepay your mortgage insurance. I'm sorry, prepay your homeowner's insurance and property taxes. All right. Appraisal, you still have to pay for. Not, it's not all for free. You still have to pay for those things. There's no mortgage insurance on a VA. You put 0% down, there's no MI. It's crazy. It's crazy good. I put 620 credit score because I haven't really seen any 600 credit scores get approved for VA. Not to say that there hasn't existed, but that's usually an optimal number, right? Even if they have a 600 credit score, we could still do what's called the credit rescore. We pull credit, it shows what we need to do to increase the credit score, and assuming that the borrower does it, we get the credit card statements back, we'll send it to the bureaus and increase the credit score. All right. Closing costs, they still need to pay. VA certified appraisers only. So not just any appraiser can do the appraisal, okay? They do need to be VA certified. And this is the only program that they actually allow you to get cash back at closing, right? I did a loan like a couple of years ago that this VA guy was getting purchasing a new construction house, right? The in-house lender could not close them because of their guidelines, because of their overlays. They just didn't even know what the hell they're doing. And the seller was promising them still a cashback, a credit for closing. Most of those, the new construction, they're like, hey, use our lender, and we'll give you a credit of whatever, even though the fees are already high as it is, right? But they're putting 0% down. The builder was giving them like $12,000 of credit. His closing cost was like $10,000. The guy literally walked in the deal with $2,000 in his pocket. It's crazy. That only happens really in VAs, you know. Co-signers can only be spouses. So if I'm a veteran, I'm retired, I can't have my son co-sign. I can't have Alain, Rafaela, you know, Olsaris. I said that right? Olsaris. Oh. I can't have anybody else sign, only my wife or husband, right? Let's see. I want to point it out. Let's say I was a veteran and I passed away. My wife can actually still apply for a veteran VA loan. I learned that when I was a realtor like 7 years ago. I've never come across it as a loan officer, but when I was a realtor, when I used to work for Kai's, that was a scenario. And the loan officer never closed that loan, by the way. The one I was working with. All right. Really cool fact. When you talk to veterans, and even the veterans don't know this stuff, if they are disabled veterans, right? Let's say they're 50% disabled and they have a certificate of how much percentage they're disabled. Whatever they're disabled in that percentage, right? They're gonna get that discount of that amount on their property taxes. This is huge. So if somebody's 80% disabled on paper and they have the certificate, once they buy the house, if they buy the house today, next year, January 1st, they can apply for the homestead exemption. Tell them to show their disability percentage. They're literally going to get that much percentage off their property taxes. It's huge. It saves them thousands and thousands of dollars. All right, hold on. I see here we have a chat. Oh, showing some love. Smiley face. All right. So yeah, that's pretty much VAs. I mean, these are the three cookie cutter loans programs that, you know, FHAs and conventional, the majority, you know, of everything. VAs, you know, you'll get them from time to time. Any questions about these? Joey, you got any questions? I know this is your first time here. Rafaela too. Marlene.
Nah, man, everything is crystal clear.
Yeah. I know Alain and Mike, they could probably teach this class for how many times they're here just for support. They know probably most of the stuff already, but they're here for support.
Victor, will we have access to this? Like if we want to like rehash it later?
Yeah, I mean, I have a PowerPoint. I don't mind sending it to Victor and then sending it to everybody, you guys. I think he has like a mass email already generated. So I don't mind
that
sending
would
it
be
to him.
great. Okay, that would be great.
Yeah, again, I don't expect you guys to know every single line item, you know, like this, you guys are not becoming loan officers here, like, but it's good to know, like, oh, did you know if you're a veteran, you can 50% off, you know, you get 50% off your property taxes, that'll save you like $300 a month. You might as well buy a house, not rent, you know, little things like that.
Yo, I'm here to find out, how do you buy a house with no income, man?
Oh, that's for the last, bro. That's the last question of the day. Oh, no, but no credit too.
No credit?
And no down payment, right?
That's like the guy that goes to buy a car and they're like, yeah, you don't even need to have arms, bro. You just come in. We'll sell you a car. No arms, no legs. You got it.
I know, crazy, right? That's funny. Please send us the link to the recording. Yeah, I'll send you everybody the link as well for the recording. I think it's going to be saved in the cloud, Victor's cloud. So I'll get with Yessi to see how we're gonna handle that. Okay, so we went over the three basic, you know, loan programs. I'm gonna jump into like kind of like the alternative program that there are. These are called the non-QMs, non-quality mortgage. And it's exactly what it sounds like. They're not quality mortgages in the sense that you're not gonna get the best interest rate, best low down payment. These are literally like portfolio type loans, not really private loans. They're not hard money loans, but there's a market for them. And I think I heard we were talking to some other banks to get, you know, some other lenders signed up. There was I think one of the reps is like, oh yeah, you know, Florida, California, New York are the leading states in non-QM loans, meaning the bank statement loan, investor solutions loan, and a foreign national loan, you know. Let's see here. So again, I'm gonna go over some key points. You know, if you do have any, you know, borrower scenarios like this, you know, we'll talk about it. You know, we do have, you know, 12 months bank statement loans. We actually even have 1099s now. So if they have like 1099 that they received, you know, from one company, you know, assuming we can document that for the 1 or 2 years, then, you know, they can be eligible. All right. So they do need to be self-employed, you know, business owners only for this month bank statements. If they don't actually own a business, but they're self-employed, like a DBA, that is still acceptable, right? But they do need to have a history about 2 years in the business, right? So if they're doing landscaping, pressure cleaning, this would attain to them. I've seen some of these types of loans are only for clients that don't report all of their income, or they haven't had enough income because they had a lot of expenses that year, you know, and they don't show enough to get qualified for the other loans. This, you know, this is an option for them, but they do need 10% down. There is a higher down payment. Credit scores are pretty lenient, you know, as low as 600. You know, talking about interest rates, I mean, you're talking about maybe at least 6, 7, depending if they have a high good credit score, maybe even 5. You know, the closing costs are a little bit higher than the regular quality mortgage loans. But this is something that, hey, if they want to buy a property, they like the property, they have cash, get them, find a loan for them, you know, and then have them refinance in a year, 2, 3 years later when they're more settled in. You know, everybody's situation is different. You can use this for primary residence, second homes, and investment properties. Okay. If they want to take cash out, they can take up to 80% of their property. I did this type of, not this one, but I have another, the next program here, I'll jump into that. Actually, I'm gonna hold off on that, but they can take up to 80% on properties. And again, these are for borrowers that maybe haven't even filed the tax returns, or they just had a bad year, or their tax returns didn't show all their income that they normally make. So that's why we look at the bank statements in short of that. If they had recent foreclosures, bankruptcies, short sales are okay. You know, we do have a chart, a matrix. You know, they have to have it surpassed for a certain amount of time period. I don't know those numbers at the top of my head because these things are always changing, especially after COVID. So I can go back depending on the scenario. They have 30-year fixed, you know, 5-year fixed, 7-year fixed, 10-year fixed options. So adjustable rate mortgages. So they're fixed for the first 5 years, 7 years, 10 years, and they become adjustable after that. Let's see. Investor solutions. This is literally for investors, renters. You know, this is not fix and flip, guys. This is not fix and flip. This is literally for rental passive income, because these do have prepayment penalties involved with them as well. You can actually remove it, but at the cost of a higher interest rate. You know, banks need to make their money. So this is literally just for investment properties only. 620 credit score. We do not show, because remember, this is not primary residence, guys. This is not primary residence or second houses. This is investment houses only. Okay. We don't need to show how much money you make per month. We don't need to request employment information at all. Okay. We can go as low as 20% down. Some cases with a good credit score, we can, an experienced investor, we can probably go 15% down. Cashing out, there is a restriction. They can go 70% out. All right. Years ago, there's this realtor who asked me, hey, I have a client that has 3 paid off properties that they bought a cash like 7 years ago, fully paid for. We refinanced 3 of their properties into condos, cashed out, and they were able to buy 3 more lower amount properties. This was like, again, 2-3 years ago. Right now, it's so hard to find deals like that, you know, get your deals accepted, but they were able to purchase and finance 3 other properties, you know, and that was 3 new deals, you know, that they took their money out. and their company, their LLCs, didn't show all of the income on there. So this was the program for them. You know, rates were like at 6%, but they were cool with that because they were renting it. The numbers made sense for them. Again, these do have a no prepayment penalty option, but we can put a prepayment penalty to help better the interest rate, because it's all the risk factor. All right. And foreign nationals, the foreign national doesn't come very often, you know, but some key points do come by. They must not be a citizen or permanent resident alien for this type of loan. Even certain visas, if they have a visa, they're probably ineligible, because for foreign national loans, they literally want people that are not here, like they're not here on a permanent type of status. You know, if they're a tourist, they'd be okay. You know, I'm from Peru. You know, people from Peru, they're you know, their citizenship is in Peru, and they have no social here, or they may have a social a long time ago they came here, but they're not here legally. You know, they're not here legally to stay. They don't have a type of visa where they're here for an extended period of time. No credit score needed, because, you know, international buyers, sometimes they don't even have a credit score system. Some information that we normally need, you know, like a CPA income letter from the foreign country, bank reference letters. This is like old school stuff, right? This is a letter from, let's say, their Bank of America saying that Mr. Lamas has been banking with us for like 7 years, and he's had 4 mortgages with us, and, you know, we need at least a 2-year relationship of that. And down payments can be at least 25% down. Condos, you need a little bit more money down. The same thing applies. You can take cash out. Prepayment penalties, they're not mandatory, but again, you could add a prepayment penalty for a better interest rate. All right. Let's see, we have a chat here. Yeah, everybody needs to get qualified. Everybody needs to get pre-qualified. You got to have documentation. You have to have a credit score. For national, not a credit score because it's international, but like the investors and the bank statement loans, absolutely, you got to have a credit score. Yeah, pre-approved, pre-qualified, everything. Yeah, we need to know what type of, if they can even fit the program that exists for them. Because if they have a 500 credit score and you're trying to get them into if they have a couple rental properties and they have a 500 credit score, we can't do this loan for them. We can't just do the loan because we want to do the loan. Most likely, they're going to probably need a private hard money loan, which they don't give 2 cents about their credit score and the equity, or if they have a job or not. Mind you, you're probably looking at lowest I've seen 8%, 9, 10, 11, 12, 13% all day, all the time. All right. But yes, you do need to qualify for each of these programs. These are not free programs that, you know, well, here's a loan and goodbye. You have a heartbeat and bye-bye. You still have to, you still got to get pre-qualified for them. Any questions about the programs before we jump into just kind of like what things to look for? No. I tell you, man, I think next time I'm going to be doing this in person, because I feel like in person, it's a little bit more personal. I feel like I'd never liked Zoom. I really don't like Zoom, online stuff. And we can connect with more people easier, but I feel like in person is way better. And then there's food involved.
Food always makes things better.
Yeah, exactly. And not only that, like I don't even know if you guys are there. You know, everybody's muted. I don't hear no laughs. You know, trying to crack jokes. It's, you know, but yeah, that's just me. You know, that's me. So, all right, we'll probably have more questions at the end, but we're almost done here. Yeah, it's been like 15 minutes. Okay, not that bad. We've probably been here longer if there's more questions, but so new realtors, experienced realtors, veteran realtors, doesn't matter. like these, you should always keep an eye out for these things here. As I said before, we will touch up topics of concern because some of these things can make or break your deal, and can also, by losing a deal, you could lose more potential deals because they may not want to buy with you or sell with you, you know. So contract pitfalls during contract: always be aware of the loan commitment date. You know, that second page on the contract where it says, you know, buyer has 20 days, 25 days, 30 days to actually provide a loan commitment date. Always keep an eye on that date. Even if you have a transaction coordinator, don't depend your paycheck on somebody else's responsibility. At least this, keep an eye when this can happen. Because if you guys don't keep an eye on this and there's no loan commitment provided and you're in a tough spot, you know, you can point fingers, but at the end of the day, who's gonna, you know, have all the you know, all the pressure, and you're gonna get it from, you know, your client. You know, you lost their escrow deposit. Nobody wants to go through that. And if you are cutting it close, always send an email. And I see Mike do this a lot. He lets everybody know what's up front. He said, hey, we need, you know, we're not going to provide this loan commitment in time. We need a couple more days. When you're extending loan commitment, try to extend the closing date if possible, depending on the scenario. But you try to kill two birds with one stone, depending on the scenario. Okay. Make sure to check off the correct financing program on page 2 of the contract. Whether if they're applying for FHA, conventional, VA, check that box, because you never know that other side, the other agent has the attorney waiting for somebody to slip up and, you know, do it incorrectly and then go after the deposit, right? Have the borrower, if they're financing, right, and they're in contract, nag them and say, hey, did you finish applying with the mortgage lender? Did you guys sign all the docs? Go after them, because the quicker they apply for the, or I don't want to say apply pre-approval, and I mean by this by pushing the process forward. Hey, did you send the loan estimate? Did you order the appraisal with the lender already? Make sure to get them push that, because the quicker they apply, the quicker they pay for the appraisal, the quicker the processing happens. Okay. Appraisal and permitting. It's always good practice to require the seller, in writing, of course, to close any open and expired permits. Victor's not here right now. I know Yes is here, Mike's here, Alliance here, some experienced folks here. Do you guys know if they changed the contract to add this in there? I feel like they did, right?
No, not really. I see that, but what happens, I just saw one today, actually. A seller selling the house. You're talking about the permits, right?
Yeah, like for example, like if there's like a gazebo in the back that was not permitted, and or there was an open permit, it was expired permit, they just never closed it.
Nah, so I just saw one right now, actually, on HomeSnap. The seller doesn't have an open permit, but there's a permit from 2017 that they're saying is closed or not closed, is confusing as hell, but they make you sign it off, saying that as the buyer, you hold the selling people not liable for anything. That's your problem now. You're buying the house like this. So, but they put it in the seller's docs. It's an own individual doc. Let me see if I can find it.
But okay, was this disclosed up front or in the middle or the end of the process?
No, right there. It was in it tells you. So it says, please read the addendum. You must sign this along with the offer. You must send all this regarding the permits that were taken in 2017.
So the seller,
seller's telling you up front.
The seller's telling you up front because they don't want to say, oh, you never told me this. The seller's saying, hey, there's this thing that it's expired and you're taking it as is, straight up front.
They even worded it saying that it doesn't show open, but it never closed either. So it's kind of like tricky wording that they're using over there.
Oh wow, yeah, I don't know. That does sound very tricky.
Yeah, no, that's why I told my buyer, I'm like, dude, I'm not getting into that with you. I don't even know what it means. I mean, it was the
Yeah,
electrical panel in this particular one that I looked at today, the electrical panel. I'm like, bro, I mean, you really want to buy a house with electrical panel issue or whatever they're saying over there? So we moved away from it because of that. We got scared of that.
yeah. So that's yeah. So, but I mean, as a buyer putting in offers, as a buyer's agent, it's always good to say, hey, the seller must close any open permits and expired permits to give them the pressure, unless Line just mentioned the seller said first, hey, this is what's going on. You're gonna take it as is, no matter what. Don't tell me later that I gotta do this, this, and that. Right? The seller said, this is what's going on. You need to take it as is, as opposed to the buyer putting this in the contract first and then asking the seller to close it and giving the seller responsibility to clean up their stuff, to clean up their act, right? And you can actually use this as a negotiating tool afterwards. You know it's open or expired, but you told the seller already, hey, you need to close it off. So you can use that as leverage on a seller credit, or whatever it is. You can use that as leverage. When you see that there's some damage and structural issues within the property and the borrower is applying for financing, I strongly recommend you run it by the lender or the bank or whoever it is, the mortgage broker, to say, hey, this is the property. Try to take pictures and send it to them. Is this going to be an issue? FHAs, like if there's like rotten wood on the fascia on the top roofs, sometimes the appraiser notates that, and like half of the thing's eaten by termites and stuff like that. Hey, try to fix it before the appraiser goes in and address it, because if they go over there and then there's like electrical wires hanging out, all that stuff is hazardous, and they're gonna require it to be fixed. This appraisal value is subject to X, Y, Z being fixed. So try to address that up front. Leak stains in the roof, like, come on now. It's all liability. It's all liability. Is there a leak or is there not a leak? If there's stains, the appraiser may be like, hey, this appraisal is subject to a roof inspector certifying that there's no leaks there. If there's plumbing stuff just hanging out, try to address it. Or if they're going to repair it afterwards, do like an escrow holdback, try to see if we can get that afterwards, fixed after closing. If it's minor, nothing major, right? And also, if you know that there was, if you have an FHA buyer, listen to me, guys, that if you guys don't know this, if your buyer is FHA buyer and you're buying it from an investor, right? And today is June 8th, and you notice on the public records that they bought it in May 1st, last month. So they acquired it last month and they did some, repairs, and now they're selling it a month later, right? And your buyer wants to put an offer on it with an FHA purchase. The buyer is not eligible to purchase that property until 90 days after their current owner bought it for. Essentially, you would need to wait 90 days after that investor bought that property. So all of May, all of June, all of July, come August 8th or whatever, that's when you get in the contract, okay? It's the date of the contract. After the 90th day, you're eligible to purchase the property, okay? The loan will be denied. And I know this the hard way because I've done that when, my early years as an LO. I just went with it. It was suspended, but the underwriter was nice enough. Hey, can you guys give me another contract? They literally said, we passed the 90th day already, but they're like, hey, just get another contract and, let's revise the loan. So we did that. Pretty easy. Condo association, see, look, it's been such a long time since I've done this program training. It says 2019. It says 2019 on here. Whether you have a listing or you're purchasing a property on a condo, always ask for the current year approved budget. Always have it. And this is literally for another time for conventional loans and classes on condos. But, you know, I can help you guys read how those budgets works. So you guys know, you know, if you're wasting your time or not. There's even sometimes you can always add line items back to make the reserves work. But always ask for this and keep it handy because they will ask for this. Realtors and lenders will ask for it, especially if they're getting finance. Also ask if there's any current litigation in the building, right? If they're being sued by some company that there's a slip and fall, those litigation documents are going to be requested for the lender. Because when we ask the condo questionnaire form, it will come up. All right, it will come up, and we will need documentation of that. If there's a high percentage of units in default, that is a red flag. That most likely may or may not close, and it's unfinanceable. You know, and this goes for primary residents, second home, and investors. Every time there's a high default rates, like a lot of foreclosures, that's not good for anything. Even though nowadays, if they're not paying their mortgage and they're in forbearance, they're probably going to sell the property because equities, people have so much equity right now. I honestly have a hard time seeing like a foreclosure right now. I mean, you know, maybe even next year, but like if you're going through if you're going through forbearance and you can't pay the mortgage and you're writing it out, most likely you still have equity. You might as well just sell the property. It's crazy. That's why you know, a lot of people say there's going to be a flux of foreclosures coming out now. I mean, I don't think so. There might be a wave, but it might take a while. If there's a high percentage of investors in the association, that becomes an issue for second home and investment purchases. From a primary residence, it's irrelevant. They don't care. But these are very important questions to keep an eye out for. You know, this is the last slide, guys. Last slide. You know, if employment changes, like if there's a graduate that's at FIU university, that they're trying to get a degree for doctor, nurse, engineer, lawyer, and they get a job, they're eligible to purchase after 30 days. So if they've been in that job for 30 days and they got their degree and a doctorate or a lawyer, and they started a new job and they never had a job in the past, never worked in their life, and they went to school, they got their doctorate degree or their whatever master's, and they get a job within that field, they can purchase after 30 days. I think we got a loan, me and I think Raymond Chirino a while ago, because he didn't even know about this. And when I went over this training like 2 years ago, like we got a nurse loan that just became a nurse, and we ended up closing on that deal, right? We got a W-2 borrower that says, oh, I want to stop my Publix job, and I want to go sell cookies as a business, and it's making you $1 million a year. Unfortunately, you cannot buy a house through conventional or FHA right now, because going from a W-2 salary to a 1099 or starting a new business is not good. We need a 2-year history, okay? But if they've been in the business, if they've had a good business and the numbers make sense and they've been around, and then they said, you know what, I don't want to continue doing the business, I don't want to be self-employed anymore. Let's say they were a restaurant owner and they said, forget about it, I want to stop being the boss of my restaurant. And then that person gets a job as a manager at a different restaurant and they get a W-2, we're okay with that. But it's vice versa, which is a lot more risk because you don't know how the business is going to end up doing. So that's why they require a 2-year history. If the credit score is a lot lower, we can always do what's called a rescore system to increase their credit score, you know, within a couple of days, take like 3-4 days. We just did it last week with Michael Alcantara's client, and we ended up getting it from like a 680 to a 700. Crazy enough, conventional loan didn't even work. It was insane. I don't even know what the heck, you know, what happened with that one. But do not advise the borrower to pay off the credit cards or any kind of collections without consulting a mortgage professional, because sometimes by paying certain credit card off or collection, it will hurt the credit score. I don't know why. It doesn't make sense, but this is one of those, the credit score system, especially for mortgages, is just funny. But always, speak to us about it. Large cash deposits into a bank account will never count for available funds for closing, because due to the Anti-Money Laundering Act, it's a red flag, and you cannot source, like, if you're dropping 10K, 15K in cash, you can't really prove where it came from. So that's why underwriters and mortgages, even any types of mortgages, they don't allow that acceptable source of funds, because any type of assets that you have in the bank accounts need to be deposited. They need to be already in the account. And if there's large deposits or transfers, they're going to question, hey, where did this come from? But yeah, I mean, that's pretty much it. I don't know if you guys want to open up the floor, talk about anything we went over. What you guys been seeing out there as of late?
Hey, Angelo. So, I understand everything that you were saying, especially like going from a W-2 to a self-employed. Now, remember a special case with Fred. He was, I guess, W-2, and then he went self-employed. But you mentioned that he could just get a job for a few months to get approved for a loan. Is that an exception due to COVID?
You couldn't get a job for a couple months? What do you mean?
No. You meant
he was W-2 and then self-employed, and then he was trying to get another W-2 job, right? He's asking, if I go back to work, will I be eligible, right?
Correct. Even though he had, what was it? I think like 6-7 months, or a year, almost a year of no W-2. I remember.
Right.
I think you said something that there was an exception on loans because of COVID when there's a gap in the work history.
So if there is a large enough, right? So if this is for FHAs actually, because conventionals I think they're more lenient, but I know on an FHA loan, if you've been working at Publix for 5 years, right, and then you don't have a work history for 7 months because of whatever reason, your new job as a W-2, you need to be there for at least 3 months on there. All right. But if you find a job within that 6 months, then you don't need to have 3 months. Usually it's like 1 month is fine, like 30 days. It's every situation a little bit different. Especially when it comes to if you're applying for conventional FHA, it can be a little mixed up a bit,
Perfect. Thanks.
Anybody else? I could send this over to you guys. I'm gonna ask Yessie, when we're done here, I'm gonna ask Yessie to see how can I send it to everybody? Just really found out how to record it. But I'll get with Yessie to send it to you guys, the PowerPoint, or maybe I'll send it to her and she can send it to everybody. I'll clean it up a bit. I saw some errors that it needs to get updated. But yeah, I mean, that's pretty much it. Alain, you've been on this training for this is like your second time, right? Third time, pretty much, no?
Yeah, I never miss one.
Never miss one. It's true. You always go to every single one. That's cool, bro.
It's fun, man. Even if you just take one little piece of information from all of them, by the time I do the 100th one, I have the whole thing 100% covered.
That's true, bro. For real.
No, but it's just to get something out of it. I mean, if I get something out of it, that's all I care. I mean, there's no way I can focus for this whole entire time. I got phone calls, emails, and everything, but I took away a couple of things that I needed to know. So I'm happy. Thank you, man. Appreciate it.
No, it's all good. I really think I'm gonna do the next one in person because I don't know. I like seeing people's reactions, you know, or maybe they'll get off mute because you can't be muted in person.
Yeah.
You know what I mean?
Yeah, you're right.
So
That makes sense.
so yeah, you know. I mean that's just me, but you know, I think Victor had some success with that, but because Victor can talk. I need to take a break, man. I was hoping you guys asked questions so I could take a break. And you know, so because there's usually always questions or like other people throw out scenarios, you know, in the past in person. So oh man, Marlene is waiting for us to answer the question in the what's up chat, the magic question.
There you go.
You know what the answer to that is credit repair, either have an increase of income or job. I mean, find down payments, get a gift. I mean, there's down payment assistance programs that we have. We do have down payment assistance programs. There's pros and cons to it, you know, but technically you cannot buy a house with no credit, no money, and no job. You just can't. You can't. You got to have at least one of the three. And if you do have one of the three, there's cons to that, you know, because if you have the credit, but you don't have income and you don't have the down payment, you really can't do anything because you probably need a cosigner.
Everybody
You know?
will be buying a house, right?
Right, exactly. And I think at least if you have two of them, we could work with that. Like if you have credit and the down payment, I mean, depending on how much down payment you have, you could probably do the investor solutions program, assuming that you want to rent it out. But if you have income and credit and you don't have the down payment, well, then we could do down payment assistance and then also negotiate with the seller to get you some credit at closing, right? But like normally the two of the three, you know, is manageable. But not having any of the three is virtually impossible. So, but no.
Is there a minimum on the income, like that case scenario, right? They have 2 out of the 3. Is there a minimum income or?
So to answer your question, I would ask you a question first and say minimum income for what amount of property? Because if it's like $200,000, what's the minimum income? Then I could be like, you know, rough estimate, you know, $45,000, $40,000, 35, even assuming that they don't have any debt, you know, car loans and student loans and credit cards. But if they don't have nothing, maybe we can do it with 38,000, 35,000, you know. Okay. What I've seen if generally if a borrower has $30,000 of income on a W-2, for example, I mean, that's gonna get you maybe like 100,000, 110, maybe 90 to 120. Okay. Very difficult at that range, and it's very affordable for that person. And if it's affordable for that person, most likely there's a lot more other people eligible to buy that house, you know, because it's a you know, the median income, more people make that type of money, so there's a lot more buyers demand. So usually those properties are, you know, fly or right. But right now this market is just, you know, I don't even know what to say about it. Everybody's fighting for scraps right now, you know. But I hope this helps. You know, I appreciate you guys you know, making the meeting here. Like I said, I'm most likely probably I want to do it in person next time, but the more interactive, you know. But well, that was good. At least I covered for Vic. I hope I made him proud, you know. So if nobody has any more questions, we can wrap up. Thank you guys for coming. Appreciate it. An hour and 15 minutes was good.
Thank you.
All right, guys. I'll see you guys around.